Hi everyone, my name is Fawad Razaqzada. Welcome to today's webinar. I am based in London, and in these webinars, we cover the major currency pairs, indices, commodities, and occasionally cryptocurrencies as well. So just to give you an overview of how this webinar is usually conducted, we talk about, well, the bulk of the webinar is spent talking about technical levels on the live charts, but we do touch on the fundamentals as well. And the idea is to keep this webinar as interactive as possible. So if you have any questions, please do not hesitate to write them in the questions box or in the chat window, and I'll be more than happy to answer to provide answers for you as and when I can. Okay, but I do cover the major currency pairs anyway, so if you have any specific questions about those pairs or anything else that I don't cover, yeah, just write them down in the questions box. So just a quick reminder that these webinars are for general information only and are not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think markets shall not be responsible for any loss that you incur. And please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. Okay, so let's now go to the charts. So obviously, Monday was a bank holiday for most of the world. European markets were closed. In the absence of the European markets, the dollar sold off on Monday. That comes despite a strong jobs report that was reported on Friday. On Monday, we also had a strong services PMI report from the US, but despite that, the dollar sold off, causing the dollar index to drop to almost 92.50, which is basically a key level of support, as you can see on this daily chart of the dollar index. Now, the dollar index has been trending higher in the first quarter. And so the trend, the long-term bearish trend has ended. Now, if I show you a quarterly chart, just to 3 months, there you go. Okay, so this is the quarterly chart of the dollar index. In the first quarter of 2021, the dollar index rose. That came after a 3-quarter decline. So the dollar rose because of several reasons, mainly because of the expectations that the Fed is going to be the first major central bank to potentially tighten its belt, possibly at the back end of this year, or more likely at some point next year in 2022. This is because economic data in the US has improved, and we've seen evidence of that. But more to the point, it's the pace of vaccinations in the US that has been very impressive. Apparently, the US is the pace of US vaccination is like on average 5 times faster than the rest of the world. So that's really important because it means when a large population of the US economy is vaccinated, lockdowns could end quicker and the economy could rebound faster than other important regions of the world. That should provide strong demand for the US dollar, pushing it higher, in my view, in the second quarter. So I think the outlook for the dollar is positive after last quarter's performance. Against this backdrop, you want to trade the dollar long against currencies where the central bank is expected to remain dovish longer, or against currencies where the pace of vaccinations is not as fast as in the US, such as the Eurozone. Yeah, so the euro dollar could be a currency pair that could fall at least in the early parts of the second quarter, because in the Eurozone, authorities are struggling to vaccinate their population, their citizens. There's been delays with production of vaccines, and things are not looking great because the number of COVID infections have increased once again, potentially meaning that holidays within the Eurozone are going to be delayed. So travel within the Eurozone is going to be delayed, which is not going to be very good for the Eurozone economy because it relies heavily on tourism, right? So that's one thing. And the other thing is data. Eurozone data hasn't, we've seen improvement, but it hasn't been as strong improvement as other regions of the world, like the US, for example. And that's going to keep pressure on the euro relative to other currencies, in my view. So for that reason, I expect the dollar index to climb higher and the euro dollar to go down in the coming days, in the coming weeks. This is the daily chart of the euro dollar. I haven't updated this chart since our last webinar, when I had drawn this falling wedge pattern, which is actually meant to be somewhat bullish, because when price goes to the support trend and reclaims it, usually goes to the other side, and so it has proved. But beyond this, the underlying trend is bearish. As you can see, price has been making lower lows and lower highs. Until that series of lower lows and lower highs end, the path of least resistance for the euro dollar remains to the downside. So specifically, a couple of levels to watch for potential resistance include 1835, this red level right here, which was previously support. And this level comes in just ahead of the 200-day moving average as well. Okay, so if I move this red line here, somewhere around this region, let me just put a box around this area. Somewhere around here is where I am expecting to see the euro dollar turn lower from. It doesn't have to get to this region, but if it does, it will make for a stronger case for it to turn lower from it. This is the sort of price action I'm expecting to see. It doesn't have to follow that path, remember, but given what I have discussed from a macro point of view, we could well see something like that unfold in the coming days. Remember, previously we were looking at this shaded region, which was previously resistance and support. Once we went below that area, we thought that any rounded retest of that could get sold, and so it proved. Now we're seeing a similar pattern here. Price support could turn into resistance. Now the 116 level is important insofar as where price is most likely to go down to next. The reason I've selected this level is twofold. First, it is a psychologically important round handle. And secondly, we have these prior lows converging there. Okay, so with that, with these prior lows, some people would look at this as the euro dollar forming a double bottom here. So people who are long the euro dollar may have placed lots of stop orders below these levels, below 116. Okay, because if rates were to get there, their analysis would get invalidated. So the area below 116, there's going to be lots of sell stop orders below, which means therefore that if price were to turn lower again, as I expect it might, and we get closer and closer to 116, then expect a sharp drop below that level, because those orders will be taken, and that could potentially cause an acceleration in the sell-off of the euro dollar currency pair. The next level below 116 is the psychologically important 115 handle, where we also have the 50% retracement of the upswing from last March. Okay, so the confluence of those two levels makes 115 a strong level of support or potential support. We shall see how the euro will react if it gets there. But 115 is also the point of origin of the prior breakout in July of 2020. Previously, that level was resistance, as you can see here. So that level is going to be the next key level of support in my view. But we are more than 300 pips away from it. So let's see if price A will get there. And then if it does get there, how it's going to react. Okay, so you have resistance at 118.35 to 118.70 area, the shaded region here, and potential support at 115. In the interim, there's going to be lots of intraday levels to watch, obviously. So I'm going to zoom in to highlight some of those levels. I mean, I don't have to go to a lower time frame. You can see it on this daily chart as well. So the first level of potential support comes in at 117.85, the high from Friday, which was taken out on Monday when price created this large bullish engulfing candle. So that level is going to be important because if we start to go below that level, it would indicate to me that people who bought on the back of this large bullish engulfing candle will have been trapped. Make sense? So if we do go below that 117.85 level and price holds below it on an intraday basis, then you could look to potentially enter short. Obviously, I'm not providing any trading advice here, but that could be one of the ways to potentially get on board if you're looking for a sell-off in the euro dollar. So if price goes below 117.85 and holds below, then the next logical targets for the euro dollar would be the low from the from Monday's range, which comes in at 17.37. Why are we targeting that level? Well, because there's going to be lots of stop orders below that level, right? So remember, the market is a function of liquidity. Price goes from one area of liquidity to the next area of liquidity. Looking at the charts, you can almost tell where liquidity lies. Usually it is above or below certain levels where you'd expect people to have placed their stop orders, right? So in this case, people who might have gone long on the back of this, it will be, or it should be below this, the low of this large bullish engulfing candle. So that's the first bear target. The next one is the liquidity resting below the most recent low, which is at 117.04, where we also have the 38.2 February trace converging. And then finally, the next level below that is all the way down to below 116, which I talked about earlier. So those are the three levels I'm looking for on the short side. But that's assuming that the euro dollar is going to turn lower from around here. Okay, if it doesn't, obviously we won't have to worry about those levels. Then in that case, we'd see where price would want to go to next. I think as things stand, I'm not even considering the bullish scenario for the euro dollar because of the weak macro backdrop for this exchange rate. But from a technical point of view as well, for as long as we have lower lows and lower highs, it doesn't make sense for me to even entertain the long idea or the bullish scenario. For me, to turn bullish on the euro dollar, it will have to create a higher high above these highs here. Okay, that these highs are the most recent significant highs which need to be taken out for me to turn bullish. Okay, so that's the euro dollar. The pound against the dollar is looking a little bit more stronger, I should say. This is because obviously the UK is in a better position than the Eurozone in terms of the race for vaccinations and so on. The UK also avoided a no-deal Brexit, remember, at the back end of last year. Economic data has been improving. Lockdowns are ending soon. They've already started to ease. And so the pound is doing okay against the US dollar. It's not doing amazingly good, but it's holding its own relatively better than some of the other major currencies in the world. That being said, the best way to look for pound strength is via a pound cross rather than looking at the cable because of the US dollar's underlying strength. So if you're bullish on the pound, I would recommend looking at a pound cross like the euro pound on the short side or the pound Swiss on the long side, pound yen on the long side, etc. Whereas if you're bearish on the pound, then perhaps looking at the pound dollar is one way to get on board. Now, in terms of the technical outlook for the pound, it's broken the short-term bearish trend line. The price has held above the long-term bullish trend. So on that basis, the path of each resistance is to the upside. But I don't like how price has come back all the way down to retest this level. This level at 138.30-ish has been a strong support and resistance in the past. We broke above it on Monday. Remember, on Monday, the markets in Europe were closed. So Monday's move can be dismissed because of low liquidity and so on. So what happens today, it's going to be really important because now today, all the markets are open again and volumes are going to be higher, significantly higher than on Monday and indeed on Friday. So what happens today is going to be very important. If the cable holds its own above this key level of support, then that would indicate to me that in the coming days, the cable wants to push further higher. If it breaks below that, then that would be a big, big warning sign. Okay. Euro pound. Euro pound is looking bearish because of the strength of the pound. And this currency cross has been in a strong trend for a number of months now. Today it has bounced back, but it's testing a key level of resistance or potential resistance at 85.40. This level is important because it was previously support in here. You can see price bounced from this level on 3 separate occasions here before giving way. This former support level is now being tested as resistance. Given the underlying trend, which is bearish, it's highly likely, in my view, that the euro pound could turn lower again from here. So that's the key level to watch for the euro pound. If it breaks through this, then the next level up could be all the way at 86.15 or thereabouts, which is the base of the recent breakdown. On the downside, the first level of potential support to watch is the high from Monday's range at 85.11. If price goes below 85.11, then the buyers would be in trouble once again. which means that the next logical target for the euro pound would be liquidity resting below Monday's range at 84.70-ish. And then thereafter, there's not much prior reference points to look at until this level right here at 84. Then below that, it's the old lows at around 83 mark. Okay, so lots of potential support levels on the way down for the euro pound, but ultimately the trend is bearish, and as such, I would be expecting support levels to break down and resistance levels to hold. So the first level of resistance is being tested right now. I can't see any questions, guys. If you have any questions, please write them in the questions box or in the chat window. All right, let's move on. Let's look at a few commodity dollars, okay? I'm going to start off with the Aussie dollar. Again, these charts are not updated from our previous webinar, so I do apologize if there are a couple of extra lines on the charts that are no longer relevant. But in most cases, or in this case anyway, the levels are still relevant. The Aussie dollar has created a head and shoulders reversal pattern. This is the left shoulder, this is the head, and this is the right shoulder. The neckline of this pattern comes in at 75.60-ish, 65. This level was tested a couple of times. On Thursday of last week, it tried to break through that level. But what happened instead? Price rallied from the lows, creating a hammer-like candle. So when you look at that, you would think that there's a possibility that the Aussie dollar has formed a low, right? And it kind of makes sense because of the false breakdown scenario, etc. But you have to remember why the Aussie dollar bounced on Thursday. Well, one of the reasons it bounced is because of profit taking ahead of the long weekend break. Right, so Friday and Monday were bank holidays in Australia, and also overnight we had the Reserve Bank of Australia meeting. So ahead of all of those events, well, ahead of the RBA announcement and the long weekend, people who were short the Aussie, they were happy to take profit on Thursday, causing price to form this bullish looking candle. And there was some follow through at the start of this week. However, rates have now turned lower once again, finding resistance from 76.50. Is this the resumption of the downward trend? That's the key question. So what I'm going to do now is I'm going to mark the high of this hammerhead, which comes in at 76.20. And what I would like to see next is whether price holds above or below the hammerhead. I'm literally ignoring price action from the previous 2 days, okay, because of the thin holidays, the thin volumes during the holidays. So if price were to go back below the head of the hammer candle that was formed on Thursday, to me that would suggest that the buyers who bought on the back of this will get in trouble. And guess where their stops would be resting? Yes, right underneath the hammer candle low at 75.30-ish. So if we see acceptance below 76.20, then I would expect rates to drop either later on in the day, today, or during the course of this week to below last week's low, and potentially further more in the days and weeks to come. However, if we hold above the hammerhead today, By that, I mean if price were to bounce from its lows and create a green candle here, or a small red candle, then that would indicate that that the short squeeze is not quite done yet. In that case, price could then move higher to test the resistance trend of this bearish channel around this green shaded area before making its next move. Okay, so all told, I think I am bearish on the Aussie dollar because of my bullish views on the US dollar and the US economy in general. So I think the Aussie dollar is heading lower. Similarly, if you look at the Aussie, the Kiwi rather, the New Zealand against the US dollar, this currency pair is also residing inside a bearish channel. Previously, I was expecting it to test this shaded green region before resuming lower. It didn't quite get there overnight. And given the break of the long-term bullish channel, the long-term bullish trend, and the fact that we've moved below the 21-day exponential moving average, I think the risks are skewed to the downside for the Kiwi as well. On a side note, I want to share with you something interesting I've observed here. So what I'm doing is I'm marking out the previous week's high and the previous week's low. Yeah. Now notice last week it formed an inside bar candle following a sharp sell of the week before. When inside bars are formed, what happens is that lots of orders get accumulated above and below the inside bar. So if you think about it, people who have been selling the short, some of those guys will have moved their stops lower and lower and lower, and some of those people will have placed their stops just above the high of the inside bar in order to protect their positions from turning negative, while people who were on the sidelines and bullish on the New Zealand dollar, some of those guys will have placed buy stop orders above the high of the candle, thinking that the inside bar marks the end of the bearish trend and the start of a new bullish trend. Usually such setups tend to fail and get people into trouble. And I'll show you an example of that right here. See this candle? After a 2-week sell-off, price formed an inside bar candle. By inside bar, I mean the range of the candle is contained within the previous week's range. Now, in the previous week, in this case, the New Zealand dollar had formed a red candle following this reversal candle there. So what happened? What happened in the following week? Notice how price went to take liquidity above the range, and it failed, closing back within the range. And then in the following week, it continued lower to take out liquidity that would have been resting below the low of that inside bar candle, causing the formation of this candle. Now we're seeing a similar pattern. Price has moved above the high of last week's range. So far, it's failing to hold above, potentially suggesting that the buyers are in trouble and their stops are going to be resting below the low of the previous week. And logically thinking that's where price should be heading to next. Does that make sense? Obviously, if the New Zealand dollar now turns around and starts to climb back above last week's high, then that bearish view would become a little bit invalidated. But so far, it's looking good for the sellers. In any case, the Kiwi faces a strong resistance around the shaded region. So even if it starts to go back above last week's high, it could still turn lower from around this area if it gets there later on in the week. But obviously, if it starts to move above that shaded region, then at that point, you'll have to drop your bearish views, especially if it breaks above the high of this thrust candle that led to that breakdown of the neckline. So any move above this level is the invalidation level for me. In other words, that's the line in the sand. If it breaks above 71.82, I would drop my bearish view on the Kiwi. Now, if the previous week's lower breaks down, where do you think rates are going to go down to next? Well, that's anyone's guess, really. We can draw a few things on the chart to give us some objective targets. So Fibonacci's could be one such tool. The 38.2 Feb retrace comes in at 67.02, just above the 67 handle. Notice that we also have prior highs converging around that area. So this shaded region is where I would expect the the Kiwi to potentially bounce from if it gets down to this area. Because this area was previously resistance, 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 and then we broke above it. On this weekly time frame, rates never came back down to retest this area. So that area remains exposed for a potential retest. Now, if and when price gets down to this area, we may get a small bounce and then a resumption lower, or we may get a significant bounce and a resumption higher. Who knows what's going to happen? But that's where I would expect to see a more meaningful bounce than where price has formed last week's inside bar candle, which is a potential bullish scenario. But because of the fact it happened well ahead of this key support area, makes me think that this is merely a bull trap rather than anything significant. Okay, let's move on then, guys, to look at a few other markets. Crude oil is an interesting market to look at because recently oil prices have broken below their respective bullish trend lines. Both WTI and Brent contracts have done that. WTI here has broken this level. It has then where's the arrow? It's also taken out the previous low that led to the most recent up move. So we've broken this low here. And that breakdown means that we now have our first lower low, which is bearish, right? So we have our first lower lows here. Now, since that low was formed, price then attempted a rebound, and then it sold off. Attempted another rebound, it sold off. Attempted another rebound, and it sold off. So it looks like the sellers are stepping in and selling oil every time it tries to go up. Kind of makes sense if you think about it. The OPEC Plus are slowly lifting their supply curbs. US oil production is expected to increase sharply given the price gains. And demand for oil is probably not going to be as strong as people had expected a few months ago because of the renewed lockdowns across some parts of Europe. In India, we had 100,000 daily infections reported yesterday. India is a major oil consumer. If the country goes into another lockdown, that will surely hurt demand for oil. So I reckon there's a bigger risk that we might see crude oil prices fall from here than rise. You might ask why 62 level? Why is this such an important level? Well, to answer your question, in case you were asking that question, this level was meant to turn into support. When price broke out here, this level was never retested. So this is very normal, the way of people looking to buy support in an uptrend, right? So when a level like that breaks, usually what happens is people wait for a price to come back down to it, and then they go long on that level. What happened instead is price came down to that level and it sold, and it continued to go down from there without looking back. So clearly some people got into trouble there. And so the next time price comes back to that level, people who bought there, they will have looked to close their long positions. And meanwhile, sellers looking at this price action would be more willing to come in at around the 62 level. And that's what happened if you look at how price unfolded in the subsequent days. Price formed an inside bar here. Price broke above the inside bar high, hit resistance, and it sold off. And look where it went down to, below the inside bar low. Yeah, another example. This is what I was talking about when looking at the Kiwi, the New Zealand dollar weekly chart. The failure of inside bar candles. So 62 is therefore the line in the sand for me. For as long as we hold below 62, the path of least resistance for oil is to the downside. But if we go above 62, then at that point, I will have to drop my bearish view, because if 62 breaks, we will also break the bearish trend line, and price will have formed a higher high relative to that high. So at that point, it no longer makes sense for me to continue to look for bearish setups on this crude oil chart. Gold is looking like it may have found some unexpected support. Okay, so I have marked on this chart a few levels here. Most importantly, the pre-pandemic high. I don't know if you can see it clearly, but this level corresponds with this high here. That was the high price had created just before the March 2020 slump, which was then later bought, causing gold to rally to a new record high eventually. And then from there, it sold off. And what I did then is I selected the significant lows like this one and this one, and I drew a trend line from those, projecting where the next touch of the trend would come, which was somewhere around here, which happened to be around the 61.8% Fibonacci retracement against the March 2020 low to last year's high, and around the pre-pandemic high as well. So this area was always going to be very important from a technical point of view, and so it has proved, because gold has found support on a number of, or on a couple of occasions at least. But the key question is, has it ended its bearish trend? The short answer is I don't know. It's possible that it may have formed a major double bottom reversal here, but I am not so sure if that's the case, because the dollar is looking really strong and yields are still on the rise. So if I show you the bond yields, this is the US 10-year. bond yields continuing to rise. So when bond yields rise, it increases the opportunity cost for holding gold and other low or non-interest bearing assets. Gold is a commodity that does not pay interest, unlike bonds, and unlike equities, it doesn't pay dividends. What's more, it costs money to store gold, right? So in this kind of market environment where yields are on the rise, the dollar is rising, it's very difficult to be bullish on gold, even though it has created this potential double bottom formation. But I'm not buying it because of those macro concerns. There are lots of resistance levels that a gold will need to break through for me to turn bullish on this market. And one such level is 1760 to 1765 should it get there. That area was previously a significant support and resistance in the past. And for as long as it remains below that, I am not going to touch gold on the long side. I think there are better opportunities right now elsewhere than trying to look for a bottom in gold. I think that there will come a time when gold will look attractive again, but yeah, it has gone down quite a bit from its record highs, and it may look attractive to long-term buy and hold investors. But from a trading point of view, I am not so sure it has formed a low just yet. I could be wrong, of course, but yeah, that's trading for you. I don't know. I'm not convinced, in short. Similar picture with silver. Previously, I was expecting silver to do something like this. Test the trend line and then take off from there once again. That didn't play out, and this key support area I was hoping or expecting for silver to hold didn't. Instead, it broke down, and gold and silver went on to take out the bullish trend line. So once it broke the bullish trend line, my view on silver changed. I was no longer expecting this to happen, and instead I said, okay, let silver prices go down along with gold, and then we will review it at a later time. So here we are. Silver is now testing the 200-day moving average, and still kind of holding within this larger range, but in the lower half of it. Now, silver has dual usages as well as a precious metal. It is also it's also got many industrial uses, especially now in the renewable energy sector. Silver is used in solar panels and so on, electric cars as well. So there's going to be lots of demand for silver in the years to come as the world drives towards cleaner energy, which makes me more bullish silver than gold in the long term. But in the short term, I'm not sure if this is a low because of my concerns about the dollar and the rising yields. So silver it's possible silver could go down a little bit more, but right now, I'm not sure if it's bottomed out just yet. Okay, but keep an eye on silver because, as I mentioned, there's going to be lots of demand for silver in the years ahead, which makes it a very interesting commodity to potentially look for long setups on. Right now, as you can see, there's a bearish trend line in place that could well hold as resistance. Meanwhile, price is testing this area here, which was formerly support and resistance at around 25. So it's possible that silver could turn lower from here, and take out the previous week's low at 23.78 before deciding on its next move. But if it breaks the trend line, then the next level of potential resistance is 26, which is the base of the recent breakdown. Okay, guys, let's end the webinar with looking at some major indices. The S&P 500 hit a record high yesterday on thin volumes, I have to say. It's testing the resistance trend of the wedge pattern, of the rising wedge pattern, okay? So a rising wedge is meant to be a bearish pattern when price, or in this case, the index breaks the support trend. Right now, the index is testing the resistance trend. So a number of things could happen. First, we may get a small pullback and a continuation higher. And I think this is the sort of price action you should expect, given that's been rising for 1, 2, 3, 4 straight days and rising significantly from this low here. A bit of a pullback and a continuation higher, it should be the default expectations given the long-term trend and the positive macro backdrop. If it starts to show weakness if it comes back down to retest this breakout area that I've shaded, if it shows weakness around this shaded region, then that's where you could start looking for possible bearish scenarios to play out on the index. So it needs to show me that the top is in before I entertain the short idea. But at these levels, it's becoming increasingly difficult to buy unless you do it on an intraday basis. So a small pullback to the support area, and then a resumption is what I'm expecting to happen. But if that doesn't happen, then I'll entertain the short, the bearish trades or the bearish trends if that area of support breaks down. It will be bearish if the index creates a lower low. The most recent low comes in at 38.53. So it will have to break through that area for the trend to turn bearish. Short term, I'm looking at this low here. You see this doji candle, the low of that. If it breaks through that, that would be the first bearish sign. But a more significant bearish sign would be if it breaks through this low here. As I keep saying, until those lows are taken out, the part of least resistance would remain to the upside. And similarly for other major indices like the DAX index here, the part of least resistance is clearly to the upside, but the index does look overbought at these levels. It's been going up for 1, 2, 3, 4, 5, 6, 7 days in a row. So a bit of a pullback should not come as major surprise. And in any case, dips could be supported. But if the S&P 500 tops out, like how I have tactically prepared myself for that possibility, then the DAX, etc., could follow suit. But in this case, I have there are more supports to break than the S&P. We have the 21-day exponential coming in at around 14,800, which was the prior resistance area. That's now going to be the first major support. Below that, the short-term bullish trend. Then we have another longer-term trend line. Then we have the 200-day moving average. So there's lots of potential support levels that could hold and lead to fresh record highs for the German DAX index. Anyway, I have run out of time, guys. This webinar was meant to be half an hour. I have gone over by at least 25 minutes. And for those of you who joined me live, thank you so much for tuning in. I can't see any questions from you guys. For those of you who are watching this on YouTube, please make sure to join us again next time. And you can do that by going to our website, Think Markets, go to Market Analysis, Live Webinars. And here you can see the upcoming webinars that we have. This was today's webinar. You can register for the next one by clicking on the register button. It's gonna be on the 13th of April. So basically next Tuesday, same time. Once you register there, then you'll get notified by an email. And that way you can join us live for the next one. So if you haven't already subscribed, make sure you subscribe to our YouTube channel. We have lots of educational, we've got lots of educational content, as well as all the webinars that we do on a weekly basis on YouTube, so you can watch them at your pleasure. But there's lots of educational content as well. If you go to the key reversal pattern series, I have created 4 videos there. And then another one I'm currently working on is the failure of the key reversal pattern series. And I've got a few videos there as well. There's going to be lots of information in these videos that you could use for your trading. And if you do like these videos, please watch them, share them, and like them. That will encourage us to produce more such content, okay? Until next time, take care, guys. I will see you next Tuesday. Bye-bye.